Thank you. I have with me Christopher Woods, who is the Global Head of Equity Strategy and author of Greed and Fear. Chris, thank you very much for joining us on 80 Now. The biggest question today is all about US and Trump. Let me begin with that first. We heard President Trump call on Prime Minister Modi yesterday evening and wishing him a birthday for his 75th birthday there. But the more important thing is about the call that happened, because it was not happening for a couple of months. How do you see the India-US equation, moving forward from here?
Well, that's just one of several recent signals that the US side is obviously trying to becoming more conciliatory relative to the deal. So my guess is that we should get some resolution on this issue in the next few weeks and months.
Mm-hmm. How do you look at the entire Trump tariff scenario? I think the world or equity strategists were blindsided. They didn't expect Trump to go through with the tariff. Where do you see this entire episode taking us from a global trade point of view?
Right, now you're absolutely correct. We all knew that Donald Trump's always been obsessed with tariffs. To be fair to Donald Trump, he's always said he's going to do the tariffs. But I have to admit, most people thought, including myself, that he wasn't going to be as aggressive as he has proved to be in some cases. There's no way I ever expected 50% tariffs in India, for example. Donald Trump's view is that the exporters will eat the tariffs. Most economists argue that the tariffs will end up being paid by the American consumers. My own view is that Donald Trump and most of his supporters actually believe the exporters will pay the tariffs. But in my view, the longer these tariffs are in place, the more inevitably the negative consequences will show up, both in terms of American consumers having to pay more and just negative for the whole economy, for economies everywhere, because in my view, I think what we were taught in the economic textbooks, that tariffs are beggar thy neighbor policies will prove correct. But it's worth highlighting, as in Japan last week, and in Japan actually so far, Donald Trump will be pleased to see that the exporters are eating the tariffs, because the Japanese car makers have cut the prices by at least 15% for the tariffs. So one wants to be aware of that point.
But it's also leading to global repercussions. In Japan, you had the Prime Minister resigning because of the kind of trade negotiations he ended up doing with the US.
Well, that's right. The Japanese were remarkably passive. And basically, it's not clear what's actually been agreed, but what the US side said was initially agreed that the Japanese had agreed to invest $500 billion in America, and the US will take 90% of the profits and the Japanese only 10. Clearly, the Japanese are normally very polite in public, but they pushed back. But this clearly is not a good look from the standpoint of a Japanese Prime Minister. And the contrast with the Japanese passive approach and the Chinese hardline approach is very dramatic.
And between Japan and China, I think India is somewhere in the middle?
India is somewhere in the middle, but obviously the Chinese hadn't used this bargaining chip until this year. They could have done this at any time since the controls on China buying US semiconductors were introduced by the Biden administration. That was a very aggressive policy by the US. In fact, I just view it as a declaration of economic war against China, as indeed do the Chinese. But this year, the Chinese have applied the rare earth leverage. And they basically said, if you don't let us buy semiconductors, we won't let you buy rare earths.
So where does it leave the entire global leadership? It's all about narrative setting, right? Today, Trump is setting the narrative he's taking, and that's creating problems for many countries or politicians in their respective countries. How do you manage Trump's narrative?
Yeah, so actually, I think the lesson from China is it pays to stand up to Donald Trump, because we are in the ironic situation where I'll give the example of Europe. The European leadership rushed to see Mr. Trump at his golf course in Glasgow to agree a deal, which was definitely not very good for Europe. where we have the ironic situation that the tariff hikes have been suspended on China, and Mr. Trump is desperately trying to arrange a meeting with the Chinese president, and the Chinese president so far playing hard to get.
And I think he's supposed to speak to him on Friday, if I'm not wrong.
Really? Well, my guess is the Chinese will end up agreeing the meeting, but for now, it's crystal clear is that the Chinese are playing hard to get. The Taiwan president wasn't allowed to visit, had to cancel a previously scheduled visit to the US, I think in July or August. So it pays to stand up to Mr. Trump. And right now, with these efforts by the US now to reintroduce these talks, it suggests to me that the Indian approach is working, because it's obvious that it's not in the US diplomatic interest for India to be put closer to China.
Okay. The biggest thing is that you have the biggest uncertainty in terms of tariffs. A lot of S&P 500 companies have exports coming from overseas, and these tariffs are impacting them in some way. But we still see the US markets running up. Do you think that US market have peaked, or do you still see a big runway for them?
No, the US market's not running on the tariff story. The US market's running on the AI theme and what I call the AI capex arms race. And that's actually been the key theme the US market's been running on since early 23, when the whole AI theme entered the market when Microsoft invested in OpenAI. So since then, the 4 hyperscaler stocks plus NVIDIA have accounted for nearly 50% of the gains in the S&P 500. So actually the US stock market's not really got much to do with tariffs, and the economy is all about this AI capex theme.
And you see that AI capex theme has run out of steam?
No. All the evidence right now today is that the AI capex is accelerating. So we've had this AI capex story for running for 3 years, but earlier this year we had this event when the Chinese came up with DeepSeek in late January, which in my view was a very important development and remains very important. And the message of DeepSeek was that these large language models, which these hyperscalers are investing in, OpenAI are investing in, are going to become commodities. And so the AI stocks corrected sharply on that for good reason. But since then, they've rallied dramatically. And we have to remember this market in the US is driven by retail, not institutions. And the market has completely forgotten the lessons of DeepSeek, and the market's celebrating the fact that the 4 hyperscalers are guiding to spend $350 billion this year on AI-related capex, and everybody's celebrating data center construction. But in my view, this will end up in a massive overinvestment bust. Because if the message of DeepSeek is correct, that these large language models are commodities, and we have to remember DeepSeek is open sourced, then there's clearly a risk that a lot of this spending will be wasted. But the current mindset of the market is the bigger the capex spend, the better.
But why is the market looking at that way? Because you yourself said there's this learning from DeepSeek which has come in, and still the market is ignoring that.
Well, it's a retail-driven market. The market thinks AI is the next big thematic, and probably many retail investors are buying stocks because the AI models are telling them to buy the stocks, which leads to a reflexive feedback loop. But on a valuation basis, the US market is trading at an all-time high price to sales. And price to sales is an important ratio to look at, and no one on Wall Street does.
And why not price to earnings?
No, because in my view, a lot of the earnings are artificially exaggerated because it's non-GAAP adjusted accounting. But the other point is the recent tax bill in the US has technical provisions relating to depreciation and tax allowances, which actually has delayed for 2 years the impact on the P&L of these companies of the capex spend. So it's delayed the time they will have to pay for it. So, but the reality is these hyperscalers are moving from asset-light business models to asset-heavy ones, because even they make make a lot of money, about $100 billion a year, but $360 billion is a huge amount of money to be investing in capex, and it's not just them. Obviously, there's many other companies investing in this area.
So what's your call out? How long will this rally last?
We just have to watch for a change in sentiment. But the fact that the Fed's going to start easing will be a supportive to the rally, as was the tax bill. That's definitely been a support for the rally. There's another thing which has helped this U.S. equity rally, and that is that the U.S. bond market has not been selling off. But I maintain the view I've had since the start of this year, that the U.S. has made an all-time peak as a percentage of world market cap, at 67% of world market cap on December 24th, to be precise. And part of that view is driven by my base case that the dollar has put in a long-term peak, because clearly the dollar's going down, that will impact the... And I'm not saying the US market has to collapse, but there's a potential for the AI capex when it goes down. When that theme unwinds, there will be a big correction. But the key point is the dollar's in a downtrend.
You briefly mentioned about the Fed. We have the Fed meeting today, and it's widely expected 25 basis point, and some people are wagering a 50 basis point. I think the street is now looking for 6 cuts over the next 12 months, with 3 coming in this calendar year. What's your view on the rate cycle from here on, and what do you think Powell will do with respect to the commentary?
No, yes, well, that's very good. I don't have a strong view on the rate cycle. What's 100% clear is he's cutting rates 25 basis points today. And so it's 100% clear that the Fed is now prioritizing the labor market over inflation. So the labor market has been weakening, but it's more a case of people finding it hard to get jobs. It's not because a lot of people being laid off. So it's hard to argue that the US is going to recession. Meanwhile, although the inflation data last week was okay, the practical reality is inflation is well above the 2% year-on-year target. So it's quite clear the Fed is fudging the inflation target, which is obviously negative for dollar, positive for gold. I think Powell will be quite restrained in his commentary. I think he'll go back to the data dependence line, but the pressure on the Trump administration will continue to escalate. We now have a Trump insider on the board.
Mirren is there.
For Mr. Mirren. Mr. Mirren's a gentleman who wrote this extraordinary paper late last year, many investors read, which argued that in return for so-called US security guarantee, foreign creditors of America could agree to buy 100-year Treasury bonds and accept a yield cut. So the pressure will build on Mr. Powell, and the reason he's getting this pressure is not because the Trump administration is worried about a recession, it's because they want to reduce the cost of the debt servicing.
And it's gone up already in the last 3 to 6 months, because yields are not coming down significantly.
No, but the short end, because the federal government borrows almost entirely at the short end. So if they cut the federal funds rate by 250 basis points, that's going to materially reduce the cost of debt.
250 basis points?
Which is what Donald Trump wants.
But what is your view?
I have no strong view. There's no point having a long-term view. You take this one meeting at a time. The bottom line is they're cutting rates today, and they're fudging the inflation target. And if you asked a survey of economists, I saw someone report this recently, half the economists say there's no need for a rate cut, half the economists are totally against it. Because you can't definitively prove that the US is heading into recession.
How reliable is the data now, given that we've seen so much of revision to the labor?
The payroll data has never been reliable. So it has this bizarre...
But Powell has been depending on the payroll data for holding on to the...
Yeah, but if you actually looked at how this payroll data is compiled, there's a model called the net birth death adjustment, which makes arbitrary assumptions that how many small businesses have been created, how many have gone out of business. So this is a key driver. So in my view, you have to cross-reference that number. I mean, it's an important number because the market pays attention to it. But if you look at how it's compiled, you'll realize it's an arbitrary number. So you have to look at things like the Challenger job report.
So, as a strategist, global strategist, what are the key numbers that you look out for when you are formulating a strategy for the region or for global equities?
Well, the key thing right now actually is not the US economy, it's this AI capex. But the AI capex is beginning to influence the US economy because the capex data is so strong, it's actually influencing the macro numbers.
But won't that
because the US stock market is two different markets. It's all the smaller cap domestic stocks which are geared to the state of the US economy. But then there's these big tech stocks which actually have nothing to do with the US economy. These are global franchises. And they've been phenomenal investments. They're phenomenally successful companies. They've each been in their own moat. And they're global franchise, and they've been generating all this free cash flow, because they're what they call platform companies. All I'm saying is now that, if you think about it, they're beginning to exit their moats. They're converging on the same space, i.e. AI, and they're fundamentally changing their business model because they're investing a meaningful percentage of their revenues in cash flow. And they're converging on the AI space for two reasons. One, because it's the next big growth story, but at least 50% of the reason they're doing it because they're worried that AI is a big disruptive threat.
You mentioned the fact that dollar peaked in December, and from there, you see dollar weakening going forward. And that's one of the reasons why gold is going up as well. We've seen a strategic shift towards gold, and with central banks, buying a lot of gold in the last 6 to 9 months.
No longer than that.
Yeah.
The central bank started buying, you can time it to the day, when the Russian foreign exchange reserves were frozen.
Frozen.
In, I think, early 22.
Yes. So, do you see this buying continuing going forward? Is that an alternative asset class for central bank now?
Well, no, it already is. Because in terms of official reserves, after the dollar, gold is now higher than the euro.
Yeah.
So actually this year the central bank buying is still net buying, but it's slowed down. What's happening is the investors are starting to buy gold. So the flows into the ETFs, which were barely happening, have now picked up in the last year.
Yeah.
And but the basic pattern of central banks buying gold has been in place since early 22. So it's central banks outside the G7, including the Indian Central Bank, buying gold because I think the world at large outside G7 was genuinely shocked by this freezing of Russia's foreign exchange reserves.
Not just that, India is getting the gold back into India as well.
And some countries have done that, which also, I mean, think about it, makes total sense.
Because, you don't want your assets to be frozen in overseas country.
Now, back in the 1930s, people might not know, the Americans banned individuals owning gold. So anything's possible.
So where do you see the gold rally now?
Well, we've been in this range, consolidation 3,000, 3,500. So the key question right now today with gold, I think just at 3,700, is have we completely broken out?
It's an all-time high. So there's no precedent of where it can go, right?
That's right. There's a 50% chance it's completely broken out. So, which is a big deal if that's the case. Meanwhile, the most interesting area to invest on this gold theme is the gold mining stocks. Because
they've never run up earlier, but now they're running up.
They're now running, but the bottom line is in every other previous gold bull market, gold mining stocks outperformed gold because they're more leveraged. Now, I showed a chart in my presentation to this conference which shows that gold mining stocks have been underperforming since this gold bull market got accelerated following the freezing of the Russian foreign exchange reserves.
Yeah.
But we're still underperforming on gold mining stocks. So in the last 2 months, the gold mining stock line has gone kind of vertical. But what's remarkable, when I checked a week ago, in terms of flows into ETFs specializing in gold mining stocks, they were still negative year to date.
What we've seen is...
Unfortunately, there are no gold mining stocks in the Indian market.
Yeah. But bigger thing is that there is a physical shortage of gold as well, which is coming into play here. India is one of the biggest,
Is there a physical shortage?
Fiscal source.
I've heard mixed things on that one.
Because, if you look at Indians like to buy and hold gold.
Sure.
And it's if you look at the total value of the gold, it's 90% of 80 to 90% of the GDP, which in value terms, in current value terms. So, if you look at from that point of view, do you see gold running up to beyond 4,000 in the near term?
Anything's possible now because for the reason you said it broke out. So what would be very negative for gold, and my view would cause a sharp correction, is if we suddenly get a total resolution of this Russian-Ukraine conflict and all these sanctions against Russia are removed and Russia's foreign exchange reserves are completely unfrozen and we go back to the situation pertaining before it, then I can see a big correction in gold. But that's a
very remote one.
Yeah, well, that looked much more likely when Donald Trump entered the White House for a second time, because he told us he was going to end the war in 24 hours. But obviously, as right now today, that looks very unlikely.
And what seems likely as well that how Putin played Trump in Alaska, or
What do you mean played in?
Yeah.
You think he played in?
I think so, because he came out saying that it was a good meeting, but nothing happened after that.
Yeah, but on that point, I think it's, to be fair to Donald Trump, you're not going to resolve this situation unless you talk to the other side. So to me, that's a positive they actually met, because it gave an opportunity to the Russian leader to explain his position.
But since then, Trump is also holding firm that he wants additional tariffs on Russia or countries who are consuming Russian oil or gas.
Right, but I don't think India is going to compromise on that one. So our view, if the American demands are that India should stop buying Russian oil, I don't think there's going to be a deal, because I don't think the Modi government's going to agree that. Unless unless the global oil price falls enough to be the same as the Russian oil price, then they can do that. And if the American demands are that if the Americans continue to demand that India open up agriculture, I don't believe this government's going to do that either. When I say this government, the Modi government. Therefore, they can make compromises in other areas.
And do you think a deal is possible, given the fact that India is not going to open up agriculture or fisheries or dairy for the US market, US, but it's open to looking at zero tariffs across goods and manufacturing?
Yeah, no, I think all that, there was a deal and nearly agreed, right?
Yes.
But obviously the risk for India is that there's no deal, then Donald Trump gets upset again, then someone tells Donald Trump that all these US multinationals have all these people employed in the IT services sector.
The Hire Act, which was tabled in the Senate.
Yeah. So if somebody tells Donald Trump that and he focuses on that and he wants to get aggressive, then that's where he could really damage India.
So where does India stand in?
Because I think Donald Trump, when he thinks about trade, he thinks about trading goods. He doesn't really conceptualize trade and services.
True, but he's also a shrewd businessman. So in that sense, when he looks at trade, or when he looks at a country, he looks at it as a counterparty and how to make sure that he has the upper hand on it.
Yeah, no, and he's focused on the fact from the word go, on a point which I have to admit is true, that India has high tariffs.
So how do you see, you've been keenly watching India from an Asia Pacific point of view, and within India as part of the global market. Where do you see India in the whole scheme of things? You had, as I read in your letter about the photo op at China, which is the SCORE, Shanghai Cooperation Organization meet, which gave some messaging across to the US to loosen up from a diplomatic point of view. And that happened, things started moving. But do you think that India acts as a counterweight to China when it comes to US diplomacy?
Well, I think India should try and remain completely neutral, frankly, on this. I mean, it doesn't make sense for India to be in a hostile relationship with China. And so I think there was already a thaw with China for the last year.
Yeah.
And in my view, there's a significant potential for these restrictions on Chinese FDI to be relaxed, because India can benefit from Chinese investment, most particularly if it's like joint venture. So to me, there's a significant likelihood of a relaxation there. And ideally, India should try and remain neutral, not be... So India is a member of BRICS, but it's also a member of what they call the Quad.
Yeah, and also part of SCO, which is... So it's there in part of all the access, it's part of the... but it's neutral to all of them.
Yes. But if it gets really difficult, trying to maintain them balanced, then the obvious thing to do is just leave the Quad and leave the BRICS. And then you're clearly neutral.
In the entire space, how do you see the oil working, crude oil? We haven't seen much of a flare-up in crude oil, despite flare-up in Israel conflict, which is there. We saw the Middle East or the GCC countries being relatively mature in the reaction in that sense, and that has helped. OPEC has been hiking output for the last couple of months, and they're looking at increasing the output by another 1.6 million barrels in the next 12 months. So that's what's happening. How do you see oil playing a role here, and the pricing of oil?
Well, I think we're at the bottom of the pricing range, but clearly OPEC's decided to squeeze the other producers. So that's going to squeeze US shale. And they seem to be playing that game. So clearly there's a risk of further downside in oil. And that's why there is a potential possibility if oil goes further down, that this profitable arbitrage buying Russian oil ceases to be such an anomaly. But in the long run, I think in the long run, what's very interesting about energy is I'm hearing that solar combined with battery storage in China now means that solar battery storage energy is cheaper than coal in China. So that's a big deal.
And that's something which is picking up in India as well?
And that, you see, if it's cheaper than coal in China, then it's just a matter of time that it becomes cheaper in India. But clearly, India should be taking advantage of the solar technology China's developed. That's one obvious area where there should be a relaxation on imports.
Not only that, from a point of view, India is looking at nearly 500 gigawatt of renewable energy by 2030, and we've already achieved 250 gigawatts. So that's also a runway for India in terms of that. But you see more investments coming into battery energy storage systems.
Yeah, but my point is the technology is already there in China, and it's already cheaper than coal in China. So that's dramatic. By the way, when it comes to AI, that means China's much better positioned for AI than America. America doesn't have the energy.
True.
China's all the energy at once.
So who is going to win the AI race?
Well, I think, right now...
If you go by China, they're going to make AI more commodity much faster than what the world is expecting.
Personally, I think that as of today now, China looks to be having the more sane approach to me. So the Chinese approach, as described to me, is they've got this very cheap resource called DeepSeek, and they're looking for practical, commercially viable applications on AI. And as one Chinese gentleman said to me, if it's 8 out of 10, it's good enough for us. And the key point is DeepSeek is open sourced. So whereas the US, each company is trying to build the perfect large language model to get to what they call AGI, which means like thinking machines. And so they're spending all this money. But based on what I've been told by people who know much more about AI than I do, there's a lot of smart people who believe you'll never reach AGI simply by large language models, because these large language models are simply glorified search. They're the key phrase is they're pattern matches. So if that is indeed true, it creates the risk that there's massive overinvestment going on. So yeah, I think the Chinese approach as of today looks much more sensible.
In the entire equity basket, where do you see emerging markets playing a role here with respect to equity flows?
The emerging markets are doing better this year. Obviously, China's doing well. So India, there's a lot of angst that India's had this big underperformance. but really it's more about the other markets doing better. So this is a year of healthy consolidation in the Indian market, where our base case is that we're continue to trade sideways, because the high valuations mean you continue to get a lot of corporate paper coming into the market.
Yeah.
But the big domestic flows, based on the mutual fund inflows, mean that supply is being absorbed. So I think it's healthy consolidation. The positive point is the foreigners have record low ownership of Indian
And they're
stocks.
selling on a daily basis.
Yeah, but I think that might stop soon, actually.
Do you see reversal coming in? Because these were some flows going into China, Korea, Vietnam.
Well, the big flows went into China this time last year.
Yeah.
Because the Chinese market, in my view, put in a massive bottom. This time last year, like 7-8 times earnings.
Yeah.
But more recently, India's been sold to fund Taiwan and Korea, not China.
And do you see the flows reversing to India?
I think, I do. On a 3-month view, that can definitely happen. Because you just need a bit of evidence. You need evidence that all these measures, like monetary easing, income tax cuts, now, and obviously one big positive of Donald Trump's 50% tariffs is accelerated the rationalization of GST.
That's true.
So logically, this should show up in the data next year, and nominal growth should pick up.
Do you think consumption to get a big boost because of a tax cut, Reserve Bank of India's rate cuts, and then you had the GST cut coming in?
By every law of logic, you should get a pickup. So we're all assuming that. If this time next year nominal growth hasn't picked up, then we're all wrong, and then we'll have to admit there's something structurally going on. But to me, it's premature to worry about that because it's too early.
And you expect earnings to come back because there's been a slowdown in earnings, which is there. We are growing, but we are growing at a slower rate. So
the key point, though, is the nominal growth.
Yeah.
Because when companies announce, earnings and revenues, it's nominal. And nominal growth slipped below 9% this year, heading towards 8%. But actually, the most recent data came out stronger than we were expecting. Whereas historically, Indian nominal growth has been in the 10 to 12% range.
And you expect that to go back to 12% in the next 6 months?
Well, to 10 anyway. If we get back to 10, that will be good.
When do you see India to, stop being an underperformer? I mean, at one point in time, you were very bullish on it.
But I'm not looking at. I think you have to look at an absolute return. I mean, if you're a regional fund manager and you have to look at it relative. But for domestic investors in India, they should just view this as a year of healthy consolidation.
Finally,
and I think the Indian currency is hopefully about as low as. I think the currencies have, reached the low against the dollar.
Yes.
I'm hoping 89 is the low.
You think it will go up to 89?
No, I'm saying that's mentally the bottom.
Okay. If I were to ask you to rank asset classes, equities, U.S. Treasury, Forex, gold, and maybe crude, how do you rank it?
Gold I rank highest, and I rank U.S. Treasuries lowest. So in my view, G7 government bonds and U.S. Treasuries entered a structural bear market since early 22, when they printed all that money, early 2020, when they printed all that money in the pandemic. And I would put, I would put equities next, and I'd put Treasury bonds last.
And dollar in between?
The dollar and Treasury bonds are in the same bucket.
Okay.
And but I have, in my global equity portfolio, I have 10% in gold mining stocks.
Yes.
And I have 6% in the Bitcoin ETF.
Yeah. And you're bullish in Bitcoin ETF?
Yeah. I think Bitcoin goes higher, but Bitcoin's a digital store of value. And so demographically, the millennials may not buy gold.
They may go for Bitcoin.
Well, that's what's been happening.
And you see a big, good runway for Bitcoin from here on.
I think. Well, I've had that Bitcoin allocation for some time.
Chris, it was a pleasure talking to you. Thank you very much for joining us today on ET Now.
Thank you.
Thank you.
Thank you.
पैसा लगाना है तो सेंचुरी प्लाई क्लब प्राइम पे लगाओ। डूबेगा नहीं, जलेगा भी नहीं, कोई खा नहीं जाएगा, धोखा नहीं देगा, ऊपर नीचे भी नहीं होगा, सेफ रहेगा, सिक्योर्ड, मिनिमम 30 साल का रिटर्न देगा। अब इससे बेटर इन्वेस्टमेंट है तो बताओ। सेंचुरी प्लाई क्लब प्राइम, रहो बेफिक्र।